Good afternoon, everyone. We'll start in a minute. I might just put an important disclaimer slide on to start things off, just for you to read before we kick things off. Great. Okay, well, we might make a quick start. So, good afternoon. My name is Byron Slessor. I'm a Distribution Director at Channel Capital, and welcome to the final Sage Capital webinar for 2020. So this afternoon's session will be an Australian equities update and outlook for 2021. And I'm joined by Sean Fenton, Chief Investment Officer, and Kelli Meagher, Portfolio Manager of Sage Capital. So I'll hand over to Sean in a sec. So the purpose of this afternoon will be just to go through the portfolio construction and the Sage Capital process, and then we'll talk about how the portfolio is being tilted and some stocks in focus at the moment. Just some housekeeping this afternoon. We'll have questions at the end. I'll moderate that. So if you have any questions, hopefully you have a question box at the bottom of your screen that you can type in questions into at any time. And yeah, we'll answer those at the end of the session. And if we don't get through all of the questions, we'll come back to you directly on email or on the phone. But I'll hand over to Sean to start things off. Thanks, Sean.
Thanks, Byron. And yeah, Byron is here. He's just hiding slightly off camera there. But yeah, we'll get some of the boring stuff out of the way to start with, and then talk a little bit about some of the dramatic shifts in the market and where we see things panning out across 2021. So just a brief recap, Sage Capital, very experienced specialist Aussie equity boutique manager, over 26 years in developing our investment process and a long track record, led by myself and Tim, a lot of experience running long-short money in the Australian market. And we've got a very strong, aligned, focused team, a single investment philosophy, and that philosophy utilises a style and cycle neutral process. Very important in terms of delivering consistent returns in different market environments, ensuring good risk-return trade-off. And we implement that through two different fund options, which hopefully you're familiar with. So the Absolute Return Fund, targeted as a liquid alternative to cash, uncorrelated with risk assets, and the Equity Plus Fund, which is a long-short enhanced active extension fund, delivering returns above the ASX 200. So that's that in a nutshell. Just a brief recap of how we go about selecting stocks. So in one slide, the first thing we do is we actually group the market, the ASX 200, into 8 unique Sage groups. And these are groups of stocks that have similar economic risk correlation characteristics. It means we can far more effectively compare stocks on a like-for-like basis. It also enables us, by being quite neutral to those groups, control for a lot of the very difficult to forecast shifts in valuation and risk sentiment and appetite across the market. So once we've got those groups defined, so there'll be things like cyclicals and growth stocks, resources, REITs, etc. We rank stocks within each of those groups using our quantitative process. That's a range of momentum, quality and value factors. It's very objective. It enables us to basically rank every stock across the market, but within each of those groups. The next stage is to do a lot more detailed research. So we're using our fundamental experience across the team there to get real insights in terms of how companies make their money and really understand what the drivers are there and identify opportunities. So being top of information as it comes across the market. We combine the two of those together to then drive our long-short positioning across our funds. So you can see that a little bit more graphically on this slide. So as I said, the quantitative process enables us to rank stocks right across the market there. So you can see on that top chart, stocks ranked from worst to best, going from left to right, using that quantitative process. Each of the Sage groups, those 8 groups, have a similar symmetric neutral ranking there. So that's a very strong foundation for our investment process. Enables us to be quite style neutral to start with, gets a lot of objective information into the portfolio, gives us a base view on every stock within the ASX 200. But we do see a lot of opportunity to add value on top of that quantitative process. There's a lot more information that we have access to and a lot of experience that we can bring to bear there. So we've got a strong fundamental process. Kelli will actually go through a few examples of that a little bit later on in terms of what drives it. But broadly, we try and understand industry structure, top down, what's driving companies, what their particular characteristics are, as well as understanding bottom-up how they make their money in terms of understanding financial operating leverage, management quality, all those sort of things. And that leads us, it's a very independent process, leads us into some more detailed higher conviction views that you can see in that middle chart there. It's adding a lot of information, but importantly, being a separate process, pretty uncorrelated with the quant side, so that when we combine them together, in the bottom chart, you're getting the best of both worlds. So you're getting that breadth, that objectivity from the quantitative side with the in-depth information, the greater insights from the fundamental side. So that's our investment stock selection process in a nutshell, and how that flows through our two funds you can see on this slide. So the absolute return fund, it targets 8 to 10% volatility and a sharper information ratio above 1, so it's a return target above cash. And you can see that stock selection process across the ASX 200 leads us into an equal number of longs and shorts, so 50 or 60 shorts, 50 or 60 long positions, very balanced across each of those 8 stage groups as well. So a very style neutral process. It's really using that investment process to drive returns above the cash benchmark. The Equity Plus Fund is really doing that on top of the ASX 200. So you can see the index weights in the middle chart there, and down the bottom how that pans out into the Equity Plus Fund, which is up to 150% long, 50% short, but targeting 4 to 5% tracking error and return target of that above the ASX 200. So same investment process, just implemented in 2 different structures to meet different needs, whether you want risk asset exposure in terms of equities and the long-term growth potential there, or a liquid alternative to cash. So hopefully that didn't take too long. It didn't, which is good. Performance, so we've been up and running across the stage funds for over a year now, so net after fee performance, very strong on an annualised basis and very consistent over a very volatile year across 2020 as well. So it's something we're very proud of, and both funds recommended ratings for both Lonsec and Zenith there that you can see as well. So that investment process has been working very well for us. So moving along to the more interesting stuff in terms of we've gone through a state change of markets over the last month. So the start of November we saw the US presidential election. But other than that, shortly following that, we saw some big news coming out in terms of vaccines and their availability for COVID-19. So the messenger RNA vaccines from BioNTech, Pfizer and Moderna, both with very good efficacy results, 95%, and the AstraZeneca Oxford more traditional vaccine, also some dosage of that up to 90% as well. So that's really been a game changer for the market in terms of the potential to get back to normal through 2021. And the likely early approval, already approval in the UK. I think vaccination starts tomorrow. The FDA later on this week will review that as well, and they're getting ready to ramp up 100 million plus doses by the end of the year. So big rollout campaign, and that's going to change the whole scenario of lockdowns and social distancing. So whilst things are looking very nasty in the Northern Hemisphere in terms of escalating COVID cases and unfortunately deaths as well, there's certainly some very strong light at the end of the tunnel, and the markets are looking right through all that short-term noise and lockdowns to normalisation. And as you can see here, probably the clearest winner out of that has been obviously the travel sector, which has been most impacted in terms of people not being able to move, certainly across international borders from Australia, but even across states as well. So a range of travel stocks that we've listed there: Qantas, Corporate Travel, Flight Centre, Webjet, Sydney Airport, all very heavily related into the travel side. And not surprisingly through November, they've also had massive rallies. And in fact, we've been rallying ever since the lows of the market around March, April. What we're really interested in isn't so much what's happened as what's going to happen in 2021. And I think the interesting thing across this market is not just that travel is going to resume, but some of the structural changes that COVID has forced across the market as well. So for something like Qantas, as you saw in the GFC with companies like Qantas and BlueScope Steel, etc., a good crisis is an opportunity to take costs out. So they've been busy cutting jobs, but lowering their cost base, becoming leaner. You saw Virgin obviously go into administration, and Bain took that private. So potentially a more rational competitor there, although Rex has also entered the market on the domestic side. But we do see a more stable domestic competitive environment, and that can potentially offset the loss of corporate travel. We'll touch on a little bit later the whole working from home. We're obviously on a Zoom call today, but the impact that could have on corporate travel. So it could be less flying, but quite likely more demand for corporate travel services, as the duty of care to employees by employers has lifted the bar in terms of making sure that the staff are taken care of. So corporate travel and flight centre, both with corporate travel businesses and divisions, have seen that benefit picking up. They're actually being able to actually sign new accounts and see increased demand there. So of those remaining, corporate travel is probably our preference. They've actually been able to go into the US and increase their business there. The other businesses have had to really raise money either through equity or debt or a combination of the both to actually cope with negative cash flow through this period. And that's been quite dilutive for them. So if you look at, say, for instance, Webjet and Sydney Airport, their enterprise value with all that dilution is actually at record highs. So they've actually priced in a lot of recovery there as well. So that's something to be cautious of when looking at any of these recovery stocks. So travel's really taken off, pardon the pun, but probably a little bit further to go in 2021. The other thing that's happening across the market that changes there, with that vaccine accelerating recovery and all the stimulus that's out there in terms of interest rates at zero, big QE programs, we've obviously seen the restraints on budget deficits taken away as well. So governments are issuing a lot of debt, there's a lot of fiscal support there, and central banks have stepped in to monetise a lot of that. So we're in a brave new world of economic experiments there. But what that's meant is economies have weathered the storm better than expected and bounced back faster than expected as well. And with the fast return to normalcy, we're likely to see improving credit dynamics. So domestically, Australian banks have had a lot of loans go into forbearance, a lot of uncertainty in terms of what that's going to do, so a lot of provisions there. APRA stopped them paying dividends for a period of time. But since the depths of the crisis, Australia's obviously had a very good experience, ex-Victoria, I guess, in terms of managing coronavirus, and you've generally seen those loans that are delinquent or under stress generally improving, and we expect that to accelerate as well. So there's the potential for banks to actually be able to write back some of those provisions, pay dividends again, and actually you're seeing very strong demand for housing and loan growth. So the yields that they're offering in a zero-rate world actually look increasingly attractive. And important, as growth picks up around the world and yield curves steepen, that's generally a positive rotation sign for banks. Other beneficiaries there, things like Credit Corp, we probably spoke about it at our last webinar, but very much like their opportunity to actually, in once again, a rationalising debt ledger market within Australia. Their position is very strong, their balance sheet's very strong, so they can really leverage off opportunities and the ability to buy cheap credit books there and capitalise on that and grow. So they're also on a growth recovery path. QBE is another financial leverage to improving yield curves through their investment portfolio. But we like QBE actually because of what you're seeing as a dynamic in many markets around the world, which is actually improving pricing power. And globally, insurance premiums have been accelerating strongly, and it's the strongest sort of rate hardening cycle in insurance that we've seen for many years. And a general shift within the global insurance industry away from investment returns with very low running yields on fixed interest towards underwriting profit with insurance, and that's enabled pricing power to come through there. So we see QBE having a bit of catch up there. There's obviously some concerns around business continuity, insurance and interruption insurance and potential claims there that's been hanging over the sector. But once again, with vaccines, a return to normalcy and economic recovery happening faster, then some of those claims get capped and diminish. And AFG, Australian Financial Group, a mortgage broker. So one of the dynamics that we are seeing through COVID and lockdowns, demand for new housing and people working from home and having more space, but also the turbocharging of housing markets with ultra-low rates is driving demand for mortgages. So we're seeing good mortgage growth and competition there as well. And AFG is a clear beneficiary there. Within Australia, you're going to have responsible lending laws relaxed, which could allow for further acceleration in growth and a broad ongoing recovery there. So it's another stuff we like. Something like a Genworth as well, doing mortgage insurance where you've had a reasonable discount there. Obviously, as expectations around negative housing wealth are evaporating as house prices go back up, that enables them to trade back higher to book value. So, like the cartoon says, it's all about the yield curve, and a lot of these stocks are very sensitive to shifts there. So another area that just worth focusing on as we go into recovery is your traditional earnings leverage and economic cyclicality that you see across the market. And in combination with very easy liquidity conditions around the world, that support from central banks, we're seeing a real surge in commodity markets and commodity prices. So that's evident right across industrial metals, everything from copper and aluminium and nickel, and across the energy sector as well with oil. So as the industrial economy recovers, combined with easy liquidity, reasonably weak US dollar, we're seeing a real surge in those commodity prices. So some exposure there is definitely worthwhile across the portfolio. BlueScope Steel is another stock we like, which is leveraged to improving steel spreads across the US. A lot of that's driven once again by that recovery in the industrial cycle, but also in things like auto making, which is bouncing back very strongly. And finally, within the Australian market, some of the real laggards of the economic recovery, very late cycle, tends to be things like advertising. We've got event, hospitality, entertainment, so cinemas, skiing at Thredbo, those sort of things, and media, outdoor advertising. They've been pretty much not left behind, but they're laggards. And as we go through 2021, the economy recovers, some of those late cycle cyclical plays can catch up as well. So whether you're a bull or a bear, it's all about the cycle. And just briefly, where we are in that cycle, there's just a quick chart of some yield curves, the US and Australian yield curves. And as you can see, the yield curves have started steepening, have done since the middle of the year, but that's really picked up with some of the positive news around vaccines. And as recovery moves forward, we would expect those yield curves to continue to steepen, probably by the long end backing up a little bit, and just reinforcing that cyclical value rotation across the markets. So I've spoken a little bit about winners across 2021. I'm going to hand over to Kelli, because I've been probably talking too much, just to talk through one of our buy ideas. So over to you, Kelli.
Thanks, Sean. So at Sage, we aim to be style and cycle neutral, and the cycle is very important from a macro perspective, but we also spend a lot of time researching our stocks from fundamentally from the bottom up. And Breville has come up as one of the stocks that we're liking at the moment. It has benefited from the cycle in the sense of it's benefited from COVID with home lockdowns and people spending more on goods and in the home. But we also see a long runway of growth for Breville independently of the cycle as it rolls out its products throughout Europe. So at Sage, when we do our fundamental analysis, we use a framework that carefully examines industry structure and changes there, and assessing the quality of the players in the industry, company-specific factors, as well as valuation. So as far as Breville goes, the home appliance industry is relatively mature and quite competitive, but we believe Breville has several sustainable competitive advantages. The three that stand out to us is that it invests heavily in R&D, a lot more than its peers, and as a result, it produces some really innovative products that people really want to buy, and that are very different from the competition. It wins a lot of design awards and has a very good reputation for premium kitchen appliances. Secondly, it's got very strong brands. It trades under the Breville brand here in Australia and the Breville brand in the US. And its brand in Europe actually is Sage. So that's not a reason why we like Breville, but they've chosen a different brand over there because someone else actually owns the license for Breville, and it's not a very premium brand over there. So Sage is the premium kitchen brand, and it's pegged at the same premium as Breville brand in the US. So, and thirdly, it's got a really strong, long-standing, deep and wide distribution network, both in Australia, in the US, and in the UK, and it's rolling out that distribution channel network into Europe. And that is going to be a source of long-term growth for Breville, as we see going on for many years as it rolls out from country to country to country in Europe. From a company-specific point of view, it earns very high returns on invested capital. Most of its growth has been organic, and it's a fairly capital-light business. As I've mentioned, it's got plenty of opportunities to reinvest its cash flow into high-returning growth opportunities, such as the rollout through Europe. It's got a really strong balance sheet, and it generates excellent cash flow. And it's got a proven management team. Its CEO is ex-LG and has a lot of experience with technology, and he's brought a really up the ante on innovation culture in Breville since he's joined. And we also examine ESG issues with each company that we look at, and there's no notable ESG issues for Breville, so that gets a tick. It's been sold off recently post the vaccine news, and it's now below our DCF valuation, which we derive from forecasting out its growth, and it's driven a lot by the Europe rollout. So Breville is one that we like, independent of what's going on in the cycle, and it's got its independent growth trajectory. So that's one that is long in our portfolio in the Sage Growth Group. We might just take a quick pause here. You know, COVID has impacted all of our lives and no doubt changed all of our habits in some way or another across all facets of our life. And just thought we might just take a quick poll. One obvious one that affects all of us is working from home, and there's been a lot of changes this year. As of next year, though, with the vaccine and the world opening up, just we were interested in your views on how many days a week you might be working from home next year. Would it be 0, 1, 2 to 3, 4 to 5?
I have to get my glasses out to read that, but
2 to 3 looks like it's got it, John.
2 to 3, so...
Yeah.
Okay, so we've got... There we go. We've got... It's all coming through. But 40%, 2 to 3 days a week. So generally we do like working some days from home, despite some downsides. But we actually have a quarter of people saying that they're not going to work any days from home. So obviously there's a lot of us that also...
A lot of people with small children, I suspect, in the office. So that is interesting. That's when I poll a lot of people that one of the most permanent changes is obviously the access to technology as we're using Zoom today. Everyone's familiar with it, can get into a Zoom meeting certainly if not organised one, and comfortable communicating this way. So it certainly has the potential to change the way we do things. And I think one of the most interesting things about recovery is who misses out there and who are the laggards where that structural change from working from home works against us. So some of the early reversal things we've probably seen is under lockdown and social distancing, a lot of behaviours changed, desire for personal transport and mobility, avoiding public transports helped the auto industry. So there's been booming car sales, and those deliveries are starting to come through now. And also demand for housing, people moving out of cities, bigger homes, working from home, stimulated by government subsidies and low rates has also been very strong. But are we through the peak on this? I think probably very close to the peak on autos. There's just so many cars people can buy, and there's been a lot of demand pulled forward there. So we're pretty cautious on things like car sales, AP Eagers as a car dealership, and ARB is doing auto parts. So probably moving on from some of those stocks and even potentially funding shorting opportunities there. Across the building space, this is a little bit more complex. We've obviously had a lot of overbuilding in high density in Australia, a bit of surplus there, weak migration. But there's also a lot of funding for new housing, a lot of household formation picking up with low rates, and detached housing doing a lot better. So we've certainly got preference there for exposure to detached housing, things like CSR or even Stockland over more construction material intensive groups like Adelaide Brighton or Adbri and Boral, but overall probably prefer US housing where they've had an underbuild and there's some stronger dynamics there, things like James Hardie and Reliance. So some of those trends of people just at home and autos, not spending on going out and travel and services, those things are going to shift back, and you've probably got some natural losers there. But as we just did with that poll, working from home is a big one, and if 40% of people are working 2 to 3 days at home, that's a huge amount of traffic off roads in terms of toll roads that might be driving around local suburban areas and out of CBDs and out of office. So you've seen pretty big recoveries in things like Transurban. They've taken on more debt through low cash drawdowns. They are supported by long duration earnings and growth and very low rates. But could be some headwinds and a lot of sensitivity given the financial leverage there to change the traffic flows. And we really would like to see what happens there before being comfortable with something like a Transurban. And similarly with office property, if people aren't going back into the city, there's got to be some revaluations there, and Dexus and GPT are increasing their exposure away from office to account for that. And finally, just that lower volatility, stronger economic activity. It's not a great environment for gold. We saw gold really underperform coming out of the GFC. So despite the money printing and the easy liquidity, tends to go into other areas. So we've gone back to neutral on gold, and it's even a borderline short position moving forward. So that's who we see in terms of missing out. A little bit more detail there. Once again, I'll hand back to Kelli and she can talk us through a sell idea.
Yeah, so we talked about Breville as a buy along in our growth Sage Growth Group. Treasury is a short position for us, which is funding our long in Breville. It's another very specific, stock-specific investment thesis as opposed to a cyclical or cycle call. And it's been very topical of late. No doubt you've all heard about China slapping on anti-dumping tariffs onto Australian wine, with Treasury getting slapped with 169% tariff on its wine exports into China, which effectively just makes it, it just wipes out demand for our Australian wine in China, because the French wine will become a lot more attractive in comparison, and effectively wipes out up to about a third of Treasury's current earnings, and also effectively China was the key growth driver of its earnings going forward. So clearly not good news for Treasury. Basically, in terms of the whole industry in Australia, it's really, the wine industry is just not in good shape at the moment. it's not just Treasury that these tariffs are impacting. It's all Australian exporters to various extents. They've all got different tariff amounts put on them, but effectively they're all going to have to find a new home for millions of cases of wine. And this is going to result in Australia being completely oversupplied and flooded with excess wine that'll be discounted, which is fantastic for our sellers, but not good for Australian wine producers. And the regulatory risk is something that we examine for every stock that we cover, and the reg risk in selling to China was definitely a mark against Treasury when we analysed it as an investment. And I think the market has underestimated the risks around that. On a company-specific basis, its return on invested capital and cash flow is set to deteriorate as they trying to flog off their wine at a discount, and in trying to protect their really uber luxury brands like Grange and Penfolds labels, they're going to have to sell and put on in their inventory a lot of these wines that they can't sell into China, in the hopes that they'll be able to sell them at a decent margin later on, but that's going to suck on their working capital, suck on their cash flow. And China was the highest margin and priced region for them, so it's highly unlikely that any other region in the world is going to pay the sort of prices and get the margin that they could have, they used to with China. And so the risk of inventory write-downs in the future, we think, are very high. So it's not just a hit to their earnings, it's a whole raft of things. In addition, there's been huge management turnover in the last few years at Treasury, and effectively any management person at Treasury at the moment who's anyone has been only appointed in 2020, including the CEO, including the head of the US, and various other positions. And so you're sort of left with a management team who are very untested, and you've got this crisis with the tariffs, and then you've got COVID, and you've got US changes in distribution and off-premise and managing on-premise and off-premise channels, and we just feel that there's a lot of risk to the downside in execution with this company. The stock's already been sold off quite a bit, but we still think that given all of the risks and question marks around it, we still see risk to the downside. So we would prefer a Breville at this point, and so our short position in Treasury is funding our long position in Breville.
Kelly, and briefly to wrap up before we hit questions. So just as Kelly mentioned there, so long Breville, short Treasury wine. We do that across a whole range of stocks across different stage groups, which enables us to be style and cycle neutral, so not swung around by different market environments, deliver consistent superior returns in different market conditions, and just the two different fund options, the Sage Capital Absolute Return Fund, 8 to 10% volatility, returns are uncorrelated with risk assets and equity markets, so genuine cash liquid alternative, and the CC Sage Capital Equity Plus Fund, 4 to 5% tracking error, enhanced returns using the Sage Active Stock Selection above the S&P ASX 200, so a allocation within Australian equities. So we've broadly kept that on time, so over to questions. Byron.
Great. Thanks, Sean. Thanks, Kelly. So we've got about 10 minutes to go. So just a reminder, everyone on the call, please send through any questions you might have. We're very happy to answer them. There's a few coming through now. But yeah, we'll start with the first one here. So first question is, has SEEK's recent performance surprised you, and have you altered your short position in the stock?
It's surprised a little bit, but if you look at the context of the market and all growth stocks, they've all done reasonably strongly. So the whole market has lifted there, and SEEK's lifted a little bit. There's a little bit of potentially positive news of Alibaba investing into Xiaopin, which gave it a bit of a lift. But broadly, it's surprised in that you've generally seen rotation away from a lot of growth stocks, but a couple have gone on with it. And those that have gone on with it are the more economically leveraged. So it appears that people are looking for that recovery in the employment cycle with SEEK, and that's given a bit of a lift there. So we haven't done too much with our holding at the moment. We're pretty happy using that as a funder across other growth stocks as you get a broad maturation of the cycle going forward. So it can always be confusing when you've got a lot of different moving parts across the company, but we see the cyclical nature of employment as really more being a negative. It goes up and down. The underlying growth there's far more heavily reliant on an underlying a price lift. So we still see Sage's SEEK's cash generation as being reasonably poor. They're having to reinvest in a whole lot of areas, a lot of capitalisation of R&D costs and the like across their business, and a lot of investment in different pieces to support what's an increasingly competitive employment market between Indeed and LinkedIn.
Great, thanks, Sean. So the next question is, what is your active position on the big four banks, and which do you prefer and why?
Yeah, you've probably got a little bit of a hint that we've gone from being underweight to a little bit overweight banks, in particular with that improved recovery from vaccines. So at the moment, we're a little bit overweight NAB and Westpac and ANZ, and underweight CBA and Bendigo Bank of Queensland. So overall, there's a net long there. Probably at the moment, Westpac would be our preferred, just in that the valuation gap to some of the others is reasonably stark. So there's never that many differences between earnings at the end of the day. And with that sort of lift in housing prices that we're seeing working through at the moment, negative equity risks are starting to really dissipate. And some of the retail banks that were looking more exposed there in terms of CBA and Westpac actually probably had some of the best recoveries as things bounce back there. And Westpac, even compared to CBA, is looking far cheaper. So that would be our preference at the moment.
Great, thanks, Sean. Another question is, how do you look at a takeover and M&A activity?
It's one of the hardest things to forecast because it often happens in some of the worst performing stocks. So what we always try and do is not short stocks into the ground, and always have a valuation component to our modelling, and we look at value from different ways in terms of not just cash flows going forward and earnings, but potential breakup value and potential attractiveness to others as well. So we are in a period now where money's pretty free and available, interest rates are very low, lending terms are pretty generous, so the chances of PE, private equity's got a lot of capital, so leveraged buyouts and takeovers and M&A are likely increasing. So just to be cautious of being short companies that have some intrinsic value there. So something's been mismanaged or poorly managed, but it's got reasonable positioning, good quality assets. That's something that you certainly don't want to be short. But it can be throwing darts at the board trying to pick M&A. It can be random at times.
Thanks, Sean. So the next question is on process. So the question is, would you say your fundamental analysis has more of a growth or value bias?
Yeah, it's a very good question. We've got elements to both, and the way we organise our Sage groups is to really try and separate out those stocks that are more influenced by growth or more influenced by value. So any company that we look at will be looking at its growth prospects, doing value and trying to compare the two of those. But there are some parts of the market like yield and defensives and the like, where earnings are more stable. As with the quant process, the fundamental process, valuation should be more important. We pay more attention to it. Within the growth universe, we keep an eye on valuation, but you're really going to be pulling your hair out trying to make value picks within the growth sector. So we try and focus more fundamentally on who's going to deliver the best earnings over the medium and the longer term, and position the portfolio that way. So even from a fundamental perspective, we do believe in horses for courses in terms of the way we examine stocks. The key is to really not take a growth or a value bias across the entire portfolio, and segment the market the way we do, so that we can look more at growth analysis in the growth style companies. We don't sort of worry if Afterpay is trading on 25 times sales and Xero is trading on 22 times sales. I just made those numbers up; they're not likely accurate, but trying to pick value differences when things are pricing in earnings across the next decade or so is a little bit fruitless. So look at the strength of the franchise, the ability to grow, the likely ability to deliver that in the short and medium term.
Great. Thanks, Sean. And the next question we've got here is following on from your slide on Treasury wine and your last answer about M&A activity. Do you have any thoughts on a potential takeover of the company?
Yeah, I'll let Kelli answer as well, but people look at the sort of book value of Treasury, and you see numbers in the sort of mid $8 range. The problem with that is it's looking at a lot of wine inventory either in bottle or still in the production pipeline, and looking at how they can crystallise that and sell it, and that's the issue, that you're not necessarily able to achieve the same margin.
Yeah, without China, I think that inventory, a lot of the analysts are valuing at is just way too high, because there's no other region in the world that pays those sort of prices for those premium wines, and we just feel it's very questionable about whether they will get those margins anywhere, and so that we'll have to eventually write down some inventory, as well as obviously the flow-on effects of just having a wine oversupply in Australia, and also in the US to a lesser extent, but with on-premise being very weak, and so a lot of the restaurants and bars being closed, and not being able to sell wines at premium prices in that channel, sort of left with trying to sell through the grocery stores in the US. And so there is a price for everything, and certainly the Penfolds brand and a couple of the other brands of Treasury have value, but so it's something that we are watching very closely, and at a certain point we would close our shorts on that for that reason, but for now we still think there's some downside.
Yeah, the company themselves looked at spinning off Penfolds. The problem with that is, there's some great brands there in terms of, everyone loves a drop of Grange or Saint Henri or Bin 389 or something, but that's really the tip of the iceberg of their overall wine distribution. And one of the reasons they got in trouble in China is they've been using the strength of those brands to push a lot of their bulk wine sales through distributors. So if you split it out, then the remaining tail of the business is very hard to distribute and worth even less. It's not like they've just got billions of dollars worth of grain sitting in the cellars that's making up that inventory. A lot of it's sort of reasonably bulk wine, which might sit in the premium category, but you've got to bear in mind that's sort of the $10 to $20 bottle range.
That's right. And if all you're selling is the uber luxury wine labels, you're not very relevant in the US. Like the Penfolds is not basically pretty unknown in the US, and without a whole suite of wine brands, the retailers just won't want to see you just for a couple of labels, and so they kind of need the tail end to stay relevant. But a lot of those brands don't make any money, and so it's not as straightforward as Treasury would probably like it in terms of flogging off the premium brands.
Okay, thanks, guys. The question here is there a risk of a significant market correction in the short term, and how hard? Given how hard markets have run and economic data peaking post-recovery? Yeah,
there's certainly a risk where that timing sits. Markets are becoming quite buoyant, and obviously November was certainly the best month that we've seen in a couple of decades in the Australian market and globally. So a lot of money supporting things. There are certainly signs of speculation across a whole range of industries and stocks and sectors. So it's always an environment where a correction could happen. It's also an environment where the market can keep going up significantly higher while you wait for a correction. So, and there's also a difference between a correction and a significant market drawdown and a bear market. So there's certainly potential for a bit of volatility, a correction. Another bear market, I think you'd need to see something a little bit more fundamental and something to take the support away in terms of liquidity, monetary support, fiscal support. So as we get through the recovery and things firm up, that's possible. The only other one is inflation, and there's probably too much economic disruption to see a lot of inflation short term. But I would note that one of the things we've seen through COVID and lockdown is there seems to be pricing power coming back to a lot of companies. A lot of companies are able to lift prices, pass through prices, commodity prices have started going up. Consumers are being less price sensitive and discerning. So if that embeds itself as a trend, we could see inflation come back a bit more strongly, but I think that's more later on next year to worry about. But certainly, it must have been very strong, so short-term correction would not be a surprise.
Question here on shorting, Sean, just asking, is shorting now simply hard given low cost of debt, private equity firms, firepower and COVID provisions, etc.?
Yeah, look, the key to shorting and those risks, M&A and takeovers and everything else, is to run a broad diversified portfolio where your shorts are matched by longs on the other side. So whilst it's a risk to your shorts that someone comes along and bids for one of them, that makes it difficult. If you've got, say, in the absolute return fund, 50 or 60 shorts, but you've got 50 or 60 longs, you've got to bear in mind that our process is quite neutral, so we'll have some value stocks that have some potential on the long side as well. So you're just as likely to pick up a takeover target on the long side. And that can create a little bit of noise from month to month, but that's what we do see. Is when takeovers happen, sometimes we'll be long, sometimes we'll be short, but it balances out over time, and we don't fixate on it too much.
Just going back to the 8 sectors that Sage divide the market up into that are slightly different to traditional gig sectors. Can you just explain why you separate them out the way that you do, but also how you get comfortable with correlations between resources and the likes of global and domestic cyclicals, for example?
Yep. So we split them out the way we do because we're trying to make that apples with apples comparison. So we've done, and that we bring to bear a lot of our experience in terms of analysing companies and what drives their earnings, but we've also done a lot of more quantitative style correlation and cluster analysis to see how those stocks behave in different market environments and cycles. So if you can find groups of stocks that tend to cluster together and behave similarly, have similar earnings drivers, then you can make more company-specific comparisons between them, and you make more valid comparisons. There's a whole bunch of work that's gone into how we do define those. And so just to recap, defensives, there'll be stocks that are pretty immune to the economic cycle, like supermarkets or telcos. Domestic cyclicals and global cyclicals, driven more like retail, media and building and the like, driven by different economic cycles. Growth stocks we've touched on that we draw out because they're driven by a whole range of different things like valuation sensitivity, yield curves, but strong long-term growth. Resources, gold, obviously big commodity price drivers, yield, sensitive to yield curves and the like, and REITs are pretty much a cash yield proxy. So we split it out to make apples with apples comparisons. We do pretty minor tilts between those groups. But we do also run a broader risk model across our portfolio that looks at broad correlations across the market. And when we're measuring our overall portfolio risk and controlling it, that will look at correlations between those groups of stocks. And they can shift around at various stages depending on the market conditions.
Great, thanks, Sean. And final question. So do you see other potential victims of Chinese policy that could be opportunities for you?
I think the last man standing is iron ore. They've pretty much banned most of our other exports. Given Australia makes up such a huge percentage of the seaborne trade in iron ore, the reliance there, I think that's highly unlikely. But there's other stocks that are just bubbling away in the background there. Probably the greatest uncertainty is what happens when borders reopen what happens with international students coming back in. So that's a potential area exposure, and tourism and the like. So that could sort of cap out some of the recovery if we don't see Chinese tourists and students coming back.
Perfect. All right, well, that's about all we've got time for. Thanks very much for your interest this afternoon in Sage Capital. And as I said at the start of the call, if there are any other questions, please feel free to send them through to any of the people listed on the screen here in the Channel Capital Distribution, Client Service and Marketing team. And thank you very much for your support in 2020, and wishing you all a very happy and safe holiday season. Look forward to seeing you again in 2021.
Thanks all.
Thank you.